What if spending, say, $3 actually cost you 30 times more than spending $100,000? Sounds crazy, right? But in the world of Bitcoin, that's not some weird hypothetical problem.
Yeah.
It's, it's the essential structural reality that governs your transaction fees. And we need to unpack it today.
Yeah, that's a really mind-bending concept for a lot of people. So today, we're going to try and cut through the noise and help you understand exactly why that happens. Welcome to this deep dive. Our mission really is to unpack UTXO management. That stands for Unspent Transaction Output, and honestly, it's arguably the most critical but maybe the least understood aspect of managing your personal Bitcoin holdings.
Okay.
Our sources are pretty clear. Your actual transaction cost, what you pay, it's not dictated by the monetary value you spend, not at all. It's about how many distinct digital pieces, these components of Bitcoin, you're actually spending in that one transaction.
Right. So let's start right at the foundation then. For listeners, maybe they're familiar with stacking sats, buying Bitcoin regularly, but haven't really dug into the back end mechanics. What exactly is a UTXO?
Okay, think of it like this. It's the fundamental unit of money within the Bitcoin system. It's not like a bank account balance, where it just shows one number, one big total. When you receive Bitcoin, it gets recorded as a specific fixed size bill, or maybe think of it like a digital coin of a certain amount. These are your UTXOs. They're basically like digital receipts tracking precisely what you own. And here's the key part. They have to be spent in their entirety whenever you use them in a transaction. You can't spend half a UTXO.
Okay. Let's try and unpack that a bit more. We've got a great analogy from the source material that might help drive the point home. So forget computers for just a second. Imagine like an old school accountant, super meticulous, writing down every single transaction in a big ledger book. Now, if I spend $2, but I hand over two separate $1 bills, what does that accountant actually have to do?
Well, he has to write down two separate line items in his ledger. He notes, input 1, this specific $1 bill was spent. Then, input 2, that other $1 bill was spent. Two entries.
Okay.
Now, compare that simple act to spending $100, but you use one single $100 bill. What does he write now?
Just one entry, I guess.
Exactly. Just one line entry for that single input. And the key takeaway here, I mean, this is the core of this whole discussion, is that the work involved, and therefore the fee you ultimately pay on the network, is tied entirely to the number of entries he has to write down. It has almost nothing to do with the total monetary value written on those entries. Two V's $100 doesn't matter for the workload, just the number of bills.
Wow. Okay, so if I'm getting this right, the only thing the Bitcoin network really cares about, the only thing it measures for cost is the size of the data input, not the actual Bitcoin value being moved.
Precisely. You've got it. Those inputs in a Bitcoin transaction, those bills you're spending, they are data. And more inputs simply equals more data. More data consumes more of that valuable block space. And that's what drives up your transaction fees. You're essentially paying rent for the data space your transaction uses, not for the denomination of the coins themselves.
Okay, let's really nail down this metaphor for the fee structure then, because like you said, this seems essential for every single Bitcoin holder to understand.
Right. So think of the block space, that limited resource where your transaction data actually has to fit. Think of it like a small taxi cab, maybe a shared one. Now, you don't pay the taxi driver based on how valuable the goods are that you put in your suitcase, do you?
No, of course not. You pay for the space your luggage takes up.
Exactly. You pay a fee based on the size and the number of suitcases, the data that you bring along for the ride. It genuinely doesn't matter if that data represents one single dollar or $1 billion. The data size is the metric that determines the cost. And the fee is measured in something called SATs per byte. That's the standard unit, Satoshis per byte of data. It determines how much you pay for each little unit of data your transaction consumes on the network.
That structure, that reality, well, it sounds like it creates a massive problem for the smart saver, doesn't it? I'm thinking specifically about listeners who are really diligent, maybe practicing dollar cost averaging, DCA, buying small amounts regularly. Why does that strategy potentially create this long-term trap you mentioned?
Yeah, it creates what our sources call the fragmentation trap. It's a really good term for it. Because every single time you buy a small amount, let's say it's $50 every week, consistently, that purchase arrives in your wallet as a brand new, distinct, small UTXO, a little $50 digital bill. So maybe you do this consistently for a whole year. You've accumulated, what, $2,600 worth of Bitcoin, which sounds great. But if you did that 52 times, your total value isn't one lump sum. It's actually made up of 52 separate $50 UTXO.
Oh, I see. So you have the $2,600 total value, sure, but when you actually go to spend it, the network, our meticulous accountant, suddenly has to process 52 separate entries, which means it costs, potentially, 52 times the data input fee compared to if you were spending that same $2,600 that came from just one single larger UTXO.
Exactly right. And this is where that cost trap really snaps shut. It can be brutal. The people who are diligently DCAing tiny amounts, maybe just a few dollars here and there, they're often the ones who get, well, bit the hardest when network fees inevitably rise during busy periods.
Right.
You could easily end up with these tiny UTXOs, maybe an $8 UTXO that's leftover change from buying a coffee years ago that become completely, utterly unspendable. Imagine the network fee spikes and it costs, say, $3 just to include any input in a transaction. Well, now you're spending $3 just to access $8 worth of value. That's nearly a 40% fee. It basically wipes out the practical utility of owning that UTXO entirely. It's stuck.
Wow. So that implies if you have maybe hundreds of these tiny fragmented UTXOs from years of small buys or receiving small payments, a significant chunk of the value you thought you held just becomes inaccessible because the cost to organize it and spend it is too high. It really is like having a wallet stuffed full of pennies, but the toll booth to get anywhere costs $1. The pennies become useless.
Precisely. That's a perfect way to put it. You literally lose the ability to access your own value simply because the organizational structure of your digital money is inefficient for the current fee environment.
Okay, so if fragmentation is the enemy here, then consolidation must be the answer. Walk us through the mechanics of that. How do we actually practically merge all these little digital $1 bills into one big, efficient $100 bill?
Right. The strategy is what's called active UTXO management. It requires a bit of deliberate action on your part. You need to create one specific transaction, the consolidation transaction. In this transaction, you designate all those small bills, all those fragmented little UTXOs you want to combine as the inputs.
Yeah.
And the output of that single transaction is one new, large, single UTXO, a nice big digital bill. You're essentially paying the network a fee to perform that administrative cleanup task on your behalf.
And timing, I'm guessing, is absolutely everything here. You want to pay that admin fee when the network isn't swamped, right?
Critically important, yes. You need to pay the accountant when he's not busy. When the fee rate, remember, measured in SETs per byte is minimal. This usually happens during low activity periods, maybe late on a weekend or overnight during the week sometimes. The idea is you hire the network to consolidate, say, 50 inputs into one single output for a minimal fee, now maybe costs you a few dollars today. You do that instead of facing the possibility of paying that input fee 50 separate times later during a high traffic bull run, which, could potentially cost you hundreds, maybe even thousands of dollars in total fees just to spend the same value.
The strategic goal seems crystal clear then. Get down to fewer, larger UTXOs. A single large UTXO only requires one input entry when you spend it later. Compared to spinning those 50 separate small ones, you've potentially optimized your data input costs by 50 times. You're basically building yourself a clean slate, getting ready for future high-fee environment.
Exactly. But, and this is a really important but we have to address, and this raises a significant contrarian question, what's the major risk? What's the downside inherent in just consolidating everything?
Right. I mean, you're just consolidating your assets, tidying up. It sounds purely beneficial financially. What could be the dark side of that strategy?
Well, the dark side is privacy. It's a major trade-off. While consolidating definitely saves you money on transaction fees, it also permanently undermines any separation you might have wanted between your different economic activities. Let's say you combine two UTXOs that came from very different places. Maybe one came from your highly regulated KYC-verified exchange account where you bought Bitcoin legally. And maybe another UTXO came from, a private peer-to-peer transaction years ago, completely off the books. When you combine those two into one new UTXO in a consolidation transaction, you create an irreversible, permanent public link on the blockchain between the two.
Oh, wow. Okay, that is a significant risk. You're essentially broadcasting publicly and forever that the owner of those regulated funds is the exact same person who controlled those private funds.
Precisely. Yeah. And this is the fundamental trade-off that you absolutely must understand. Sometimes, actually, the peace of mind that comes from deliberately not consolidating, from paying a potentially higher fee later to maintain complete separation between your clean UTXOs and your, let's say, private or potentially gray UTXOs. Sometimes that is the smarter financial or even personal security decision. Consolidation saves money on fees, yes, but it destroys that separation, that compartmentalization of your financial history.
Okay, so how do you navigate this massive compromise? How do you avoid the fragmentation trap without completely wrecking your privacy?
It means you have to become a really meticulous manager of your own digital cash, first and foremost. Labeling. This is crucial. You need to use a non-custodial wallet, one where you control the keys, that allows you to attach labels or tags to the source of every single UTXO you receive. This came from selling the couch. This is my monthly DCA from work. Or this came from paying back a friend. Then the rule is, only consolidate UTXOs that you are genuinely happy to publicly and permanently link together on the blockchain. If you wouldn't want the sources mixed in public, don't mix them in your wallet consolidation.
Got it. Okay, moving into some more advanced strategies now. You mentioned earlier that even if we consolidate, we probably shouldn't put all our eggs into one giant basket, right? So if I have, say, $50,000 worth of Bitcoin, why shouldn't I just consolidate that into one single $50,000 UTXO? Wouldn't that be the most efficient?
It would be efficient for one future transaction fee, yes, but it's generally not ideal for overall management or privacy. You actually want some variety in your UTXO sizes. You probably need some small ones for small payments, some medium ones, and maybe some larger ones. Optimal sizes for, let's call them spendable UTXOs, are often in the low thousands of dollars, maybe up to $10,000 each, perhaps. Why? Because these sizes remain reasonably spendable, even if network fees spike significantly, say to $50 or even $100 per transaction. The fee is still a relatively small percentage of the value you're actually moving.
And there's also a whale warning, isn't there? Even for the largest balances. If you're a serious investor, maybe you've accumulated $10 million worth of Bitcoin over the years, you should absolutely not be making everyday payments directly from one giant UTXO representing that whole amount.
Yeah, that's just asking for trouble. It becomes a physical security risk, honestly. If you spend directly from a massive multi-million-dollar UTXO, you are effectively exposing your entire known wealth to everyone you transact with. Think about it. The cashier at the store, the online vendor you buy from, any blockchain analyst watching. They can potentially see the total balance associated with that UTXO. You're essentially broadcasting to the world, hey, I'm a walk and talking bank holding millions. That kind of lack of privacy, well, it can attract all sorts of unwanted attention, from theft attempts to even physical security risks for you and your family.
Okay, so in that situation, let's refine it. Say I have a large UTXO, maybe my life savings, perhaps $40,000, and I just want to spend $100 online without revealing that I have that $40,000 total. What's the sequence? What do I need to first?
All right, good question. The first step is you need to break off a smaller, more manageable amount from that large UTXO. You create a transaction where you send, say, $1,000 from your $40,000 UTXO to a brand new address you also control. This creates a new, smaller $1,000 UTXO. Your change, the remaining $39,000 minus fees, goes back to another new address you control as well. So now you have two UTXOs, but you also have two problems still.
High fees if you don't manage them, and
Yeah,
the link, right. There's still that on-chain link showing the $1,000 came directly from the 40,000.
exactly. The blockchain history clearly shows that connection. So to break that link for privacy, you need a specialized tool. The most common one, as mentioned in our sources, is called CoinJoin.
CoinJoin. Okay, that sounds a bit complex. How does that actually help break the link?
Well, it's a collaborative mechanism designed specifically to break that traceable on-chain link between your old UTXO and your new one. Probably the simplest way to grasp CoinJoin is to imagine you're entering a large public transaction along with, say, dozens, maybe even 100 other people. Everybody participating throws their UTXOs of a standard size, like that $1,000 you just created, into this big collaborative transaction pool. Then everyone takes out new, freshly minted UTXOs of the exact same values, kind of like putting your specific $1,000 bill into a giant anonymous cash mixing machine with 50 other people doing the exact same thing simultaneously. And what you get back is a different, effectively untraceable $1,000 bill. An outside observer looking at the blockchain simply cannot definitively tell which output $1,000 UTXO now belongs to you versus any of the other participants.
Ah, okay. So you pay a small fee for participating in this CoinJoin process. Maybe you end up with a slightly smaller UTXO, say $990 after fees. But the key is now when you go to spend your $100 from that $990 UTXO, you're only revealing that you controlled that specific $990 amount. You're no longer exposing the fact that it originated from your much larger $40,000 life savings UTXO. You've successfully maintained that separation and boosted your security.
Precisely. And by doing that, you've achieved both goals.
Yeah.
You've got a UTXO that's reasonably sized for potentially lower fees down the line, and you've significantly enhanced your privacy by taking active steps to manage your digital money trail.
So wrapping this whole up then, what does this really mean for our listeners? It seems the health of your relationship with Bitcoin, how well it works for you, isn't just about the quantity of coins you own, is it? It's deeply about the structure, the organization of your UTXO set. The message seems to be fix your fragmented UTXOs now while fees are relatively low, or you really risk getting burnt later when those small savings might become permanently unspendable due to high costs.
Yeah, and maybe think about this as a final thought. We often get really focused on accumulating more Bitcoin. The goal is always stack more sats, right? But maybe, just maybe, for many small savers, the highest priority right now should actually be organizing the Bitcoin they already own, making sure that the value they've carefully accumulated is actually usable and efficient when they need it. So the provocative question for you is, which specific UTXO sitting in your wallet right now will you prioritize labeling and maybe consolidating first today?
That's a great point to end on. Thank you for joining us on this deep dive into UTXO management. If you found this analysis useful, maybe learned something new, please do make sure to follow, like, and share this. You can also follow the show and specifically check out What Bitcoin Taught Me on all the major platforms: Twitter X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn for more insights like this. Thanks for tuning in, and we'll see you next time.